Yes, guys. Let us continue with our discussion of transfer pricing. In the previous class, we spoke about dispute settlement process as to how can we resolve disputes between divisions in relation to transfer pricing. So there were two methods better that we did. One was dual rate transfer pricing, wherein we literally use two rates, guys, and the other one was two-part transfer pricing system. Two-part transfer pricing system basically has two components. Now a dual rate transfer pricing system, guys, basically works in this manner. The receiving division, guys, will be debited with only marginal cost. However, the supplying division, guys, the transferring division will undoubtedly better be credited with revenue with marginal cost plus markup. So he will recover his he will recover his fixed cost. He will also make a profit margin. So there is no problem as far as that is concerned. And the receiving division as such but is being debited with only marginal cost, so you can always work out on that level of output, guys, that is optimum from the viewpoint of the entire organization. But remember, guys, if you want to take the true opportunity cost into consideration, if you do not want suboptimal decision making, then this might not be useful, guys, if the transferring division, that the supplying division has an opportunity cost better. Then under a two-part transfer pricing system, guys, the same amount that gets credited to the first division will also be debited to the second division, but this amount beta is variable cost per unit into number of units plus a fixed lump sum consideration, Now this lump sum consideration is the only amount beta that the transferring division will be using, guys, to recover the entire amount of fixed cost and also, guys, make an amount of profit. But if you think from the viewpoint of the receiving division, guys, every additional output, every additional unit beta that he receives will only result in an increase of marginal cost. So that is an advantageous thing beta to the receiving division. Okay, sir? Yes, sir. Now let us do the question, guys, that came in Jan 2021 attempt for 20 marks. Yes, guys, this question came in Jan 2021 attempt for 20 marks. Isn't that great, guys? The question is pretty simple, guys. The question is pretty simple, and let's not worry, guys, इसके बाद में जो भी examination questions आएंगे वो भी मैं cover करूँगा. How I will tell you, guys, by the end of these classes. You will know, guys. Now, Alpha and Beta are two divisions of the active multinational limited. The division Alpha manufactures auto components, which it sells to other divisions and external customers. Division Beta has designed a new product BZ, and has asked Division Alpha to supply the auto component AX, that is needed in new product. We will all read the question together, guys. By the end of the question as such, beta, you'll realize that you will be able to solve the question on your own. Please go ahead, guys. This is a 20 marker. This will boost your confidence. We are approaching towards the end of the topic. Beach mein, guys, I do accept that there were a lot of questions that were more, guys, based on the concept of opportunity cost, a little complicated. But then if you see, guys, the majority of those questions are not even part of the new ICI study material. There were few interesting questions as a part of ICI study material, beta, jahan pe bhi tumhako ICI SM nahi dikh raha na, please do not solve them one day before the examination. My job, beta, was to do more questions in this chapter because I knew, guys, that they can complicate. Just say question number 21, beta, was a good question when they said, the transfer prices will remain confidential. Question number 20 that came in the examination was a good question when they said transfer prices, beta, will be uniform. So all of this, beta, involved decision making. So इसीलिए बेटा I did quite a lot of questions. So wherever you do not see ICI SM as such बेटा बीच के questions में, it is absolutely fine, guys. You can skip those questions before the exam. Now बेटा that you're practicing for the examination, please do them thoroughly, but before the exam you can skip them. Okay, sir. Question number 28. Alpha and Beta are two divisions of Active Multinational Limited. Division Alpha manufactures auto components which it sells to other divisions and external customers. Division Beta has designed a new product called as product BZ and has asked Division Alpha to supply the auto component AX that is needed in the new product. Each unit of BZ will require one component AX. This component will not be sold by Division Alpha to external customers. Division Alpha has quoted a transfer price to Division Beta of ₹40 for each unit of component AX. When you know, guys, that you will not be able to sell anything in the external market as such, but usually, guys, the receiving division has more bargaining power because he knows better that there is no external market here. It is a policy of the company to reward managers based on their individual divisions' return on capital employed. We have learned about performance measurement and evaluation in the previous chapter. As far as financial measures are concerned, we spoke about return on investment, residual income, guys, and we spoke about economic value added. The advantage, guys, the advantage of return on investment, guys, or return on capital employed, jo bhi hai beta, is that it is a relative measure and it can be compared, guys, irrespective of the size of divisions. Disadvantage beta is that it can result in suboptimal decision making. You might not accept a contract as such, guys, which has an ROI of more than cost of capital, but it is lower than your own ROI, guys, your existing ROI. Likewise, guys, you might end up accepting a project whose ROI is less than cost of capital merely because it is greater than your existing ROI. Residual income, guys, if you try to recollect as such beta, residual income, under residual income, guys, advantage beta is that projects will be accepted only if they are viable from the viewpoint of the entire company. However, beta, residual income is an absolute measure. That is why it is not comparable between different divisions as such, guys. This problem bit of comparability can be solved if you have a budgeted or a targeted residual income, guys, and you compare the actual performance against this budget, guys, instead of comparing it with the other divisions. Economic value added beta, we all know, is based on the concept of economic profit. You write no PAT as such. So ROI कैसे compute करते बेटा? Divisional net profit divided by divisional net assets. Residual income, how do you compute it, guys? You write residual income beta as whatever is the amount of divisional profit minus capital charge for capital employed. Now, EVA as such, guys, is no PAT minus KO, guys, into capital employed. Now, while you take this no PAT as such beta, there can be certain adjustments that are required. You take profits from the viewpoint of the entire company, guys, that is from the viewpoint of all the providers of capital. So that is why it is EBIT into 1 minus tax rate. Adjustments beta can be, you are supposed to take economic depreciation and not accounting depreciation. If there are expenses like provision for warranties, provision for bad and doubtful debts as such, guys, these expenses should not be considered. They will be taken into consideration as and when they occur. There can be certain expenses that have not been capitalized because they do not meet asset recognition criteria, but under EVA beta they will be capitalized, like beta employee training cost, और research के ऊपर expenditure, guys, advertisement expenditure, operating leases. So you will have to capitalize all of them. Again, beta, taxes beta should be taxes paid and not the amount of deferred taxes. So if there are a lot of adjustments required to your accounting profit, you will write taxes beta as taxes paid plus whatever is the tax savings that you have lost on interest. Whatever is the tax savings that you have lost on interest. This is how you compute. Like this beta, you might have to make adjustments to capital employed also, but do not forget we take opening capital employed. Just say if you are reversing provision for bad and doubtful debts here, beta, undoubtedly the capital employed will change. If you are reversing, say guys, the amount of research expenditure here, you're capitalizing it, obviously capital employed will change. But see whether it is impacting opening capital employed or not. And then beta, there is overall cost of capital, and that's it, guys. You will know what is to be done. Okay, that was just a quick revision, guys, of all the financial measures of the previous chapter, because here it says that the performance is being evaluated on the basis of return on capital employed. Division Alpha produces component AX in batches of 1000 units. The maximum capacity is 8000 components per month. Variable cost is 12 rupees per component. Fixed cost per month is 60,000 rupees, which is specifically incurred to produce component AX. Specific fixed cost for division alpha beta is 60,000 rupees. Product BZ will be produced in batches of 1000 units in division beta. The maximum customer demand is 8000 units of product BZ. Variable cost will be 8 per unit plus the cost of component of AX. Fixed cost of rupees 90,000 are to be specifically incurred to produce product BZ. The head of division beta has given the following forecast. They will be able to sell 2000 units at a price of 120 rupees. They will be able to sell 4000 units at a price of 100 rupees. They will be able to sell 5000 units at a price of 90 rupees. They will be able to sell 6000 units at a price of 82 rupees. They will be able to sell 7000 units at a price of 70 rupees. 8000 units at a price of 65. You're required to calculate based on a transfer price. Okay, requirement chodo. Now guys, from this beta we know that we might even have to compute profit maximizing selling price. Remember guys, pricing decisions. Let us quickly revise that as well beta. Acha hi hai apne liye. Do not skip all of these revisions, guys, they're good. Whenever I try to relate it to a previous topic, listen to the explanation, guys. So under profit maximizing selling price beta, we have learned that the objective of every company is to maximize profits. So if there is guys, if the amount of demand is dependent on the amount of selling price, the company would obviously want to select that selling price that is resulting in the maximum amount of profits. For this, guys, you will see, guys, if the relationship between price and demand is non-linear or is it linear. If it is non-linear, guys, they will give us multiple prices, they will give us multiple demands. We will literally compute profit at each demand level and select that selling price which is giving us the maximum amount of profit. However, if the relationship is linear, guys, we will want to, they might not give us demand at different selling prices level. If they are giving us demand at different selling prices level, beta, go ahead, compute directly profit maximizing selling price. Or else, beta, what we will do is we will continue to manufacture, till the incremental revenue is equal to incremental cost. That is, marginal revenue equals marginal cost. So there, beta, we have learned about the price function, which is A minus BQ. A, beta, will be the demand of the product as such, guys. A is the price as such, guys, where the quantity demanded is 0. B, guys, is the relationship. B, beta, will be written as change in price divided by change in quantity as such, beta. That is the slope. Remember, change in price by change in quantity. B is usually in decimal points, and it's a negative relation. After that, beta, marginal revenue as such, guys, is A minus 2BQ. I told you the derivation of marginal revenue is in fact based on differentiation of total revenue, but marginal revenue is A minus 2BQ. Once you determine the value of A and B, once you get your price function, once you get your marginal revenue function, in all of these questions, beta, marginal cost is constant. In all of these questions, marginal cost will be constant. Variable cost per unit will be constant. It will not change with the economies of scale. So there are no economies of scale. So you will equate marginal revenue, guys, to marginal cost. This will give you quantity. This will give you quantity as such, guys. Once you get quantity, beta, you know that this is the quantity at which profits are maximum. You will substitute this in the price function to get the profit maximizing selling price. I hope you remember this. This is what you have done, beta, as the very first part of pricing decisions under profit maximizing selling price. Of course, after that, beta, we moved on to pricing under different, guys, market structures. We spoke about perfect competition, monopoly, oligopoly as such, guys, if you remember. Yes, sir, we do remember. Now, guys, हर जगह बेटा, in almost all the competition market structures, the objective beta was to select that selling price where the profit is maximum. I told you under oligopoly, instead of competing on the basis of prices, they can always guys, implement non-pricing strategies, work on your product differentiation, work on advertisement campaigns, work on customer loyalty, better service to the consumers. All of this beta will result that the competition is healthy and the industry survives in the long run. Chalo, guys, बहुत हो गया revision. So this is the question, guys. I think you might need a minute before we read the requirement. Take a minute, guys, read the question, and then we will come to the requirement. Take a minute, guys, and read the requirement. All of you guys, read the requirement. Yes, guys, I hope you're all done with this. I hope you're all done with this, guys. So, these are your, this thing, guys. This is the question. I will write the information better. Question number 28, right? Yes, sir. Material right in front. Yes, better. So, who's manufacturing what? Division alpha beta first. Division alpha. I'm just writing the information beta. Production capacity is 8,000 units. That is the maximum that division beta can sell. 8,000 units. Manufactures component AX. सुन लो बेटा एक बार. I'll give you time to copy. Don't worry. I'm just summarizing the information. Your variable cost per unit, guys, that they are incurring is 12 rupees. Specific fixed cost is 60,000. Production in batches of 1,000 units. Production in batches of 1,000 units. Yes, sir. So this is about division alpha, guys. And remember, guys, only transfers to division beta. Division beta, no other thing. When you talk about division beta as such, guys, manufactures product BZ, right? Yes, sir. This requires component AX. Component AX. The production capacity beta is again 8,000 units. This is the maximum that you can sell in the market. Variable cost per unit as such beta would be 8 rupees plus whatever is the transfer price. 8 rupees, correct, sir? Yes. Specific fixed cost, guys, should be taken into consideration are 90,000 rupees. And then, guys, anything else that we have here? Production in batches of 1,000 units, but again, even they are producing in batches of 1,000 units. It will not be possible for you to stop. But then, better demand is also given in multiples of 1,000 units only, guys. Demand is also given in multiples of 1,000 units. Are we clear about this? Yes, sir. So the selling price beta is would differ guys depending on the amount of output manufactured, guys. You will see that. ये copy करो बेटा सब लोग. All of you guys copy this. Yes, better everyone finish this, guys, and then we will read the requirement. I've just written the information, guys. This was a pretty simple question, but that could have been asked for 20 marks. In fact, Jan 2021 paper as such, guys. People thought it was a little tricky as such, guys, but then the questions are actually simple once you start doing them. November 2020 beta paper, when people saw the question paper, they're like everything is just same. But then as you have seen beta, every question had one small tricky point as such, guys. Small changes as such, guys. They deviated a little from the study material. So that was a very good thing as such, guys. But then people thought that they already all knew the answer. That was one reason as such, guys. Do you know, guys, that even All India first ranker as such, guys, in November 2020 attempts scored only 45 in SCMPE. Most of the answers were right, guys. A lot of people wrote correct answers, but then marks were not given. Marks were not given at all as such, guys, in that paper. ठीक है, होता है बेटा. They might just do that with any one paper. It was SCMP in that attempt. I hope you're all done with this, guys. Let us now read the requirement. Calculate based on the transfer price of rupees 40 per component. Transfer price quoted was 40 rupees, guys. The monthly profit that would be earned as a result of selling product BZ. As a result of selling product BZ. Here the situation is governed by the actions of the manager of division beta. The situation is governed by the actions of the manager of division beta. What does this mean, guys? What does this mean, guys? They're asking us to compute it for division beta first. What does this requirement mean, beta? First bit. It says, beta, transfer price to be considered is 40 rupees. Transfer price to be considered, beta, is 40 rupees. It says, guys, determine what is the amount of monthly profit that the company would earn, but the decisions, the entire situation is governed by the actions of manager of division beta. That means division beta, guys, will decide the profit maximizing output. Division beta is going to decide his profit maximizing output, guys. Profit maximizing output. Division beta will decide the profit maximizing output. Profit maximizing output. Profit maximizing output, beta, based on a transfer price of 40 rupees. Now, guys, ऐसे देखें तो the total variable cost, beta, the total variable cost of division beta, forget the entire company, guys. The total variable cost of division beta, guys, would be they are incurring 8 rupees on their own, beta, plus another 40 rupees, that is 48 rupees. ये देखो बेटा 8 plus transfer price. So we are now supposed to arrive at profit maximizing selling price only from the viewpoint of division beta, not from the viewpoint of company. Profit maximizing selling price, beta, from the viewpoint of division beta. Sir, will this result in suboptimal decision making? Can, guys, can result in suboptimal decision making. This is where the top management has to intervene from the viewpoint of division beta. Remember, guys, transfer price has no impact. We've all been learning this from the beginning, guys. I've been repeating this point again and again. Transfer price will have no impact as such, guys, on the profitability of the company as long as it is not affecting the output. But because based on transfer price, if the other division is changing their output levels, it will undoubtedly have an impact on the profitability of the entire company. Now, this is what will happen here, guys. Division beta is deciding his output level based on a transfer price of 40 rupees, which may not be the optimum output from the viewpoint of company. Which may not be the optimum output from the viewpoint of company, guys. तो यहाँ पे बेटा the selling price, the demand as such बेटा can be, 2,000 units, 4,000 units, 5,000 units, 6,000 units, 7,000 units, and 8,000 units. The selling price per unit, guys, is 120, 100, 90, 82, 70, 65. The amount of contribution per unit, guys, will be 120 minus 48, that's 72. 100 minus 48, that is 52. 90 minus 48 is 42. 82 minus 48 is 34. 70 minus 48 is 22. 65 minus 48 is 17. This would be the amount of contribution per unit. Understood, sir? So what will be your overall? Remember, guys, the fixed cost is going to remain constant. I am not telling you that fixed cost is not relevant for decision making, but then fixed cost is going to remain constant. 2000 into 72, guys, is going to make a contribution of 1,44,000 here. 4,000 into 52 is 2,08,000. 5,000, guys, into 42 is 2,10,000. 6,000 into 34, beta, is 2,04,000. 7,000 into 22, beta, is 1,54,000. 8,000 into 17, guys, is 1,36,000. The profit maximizing selling price, beta, profit maximizing output, beta, looks at 5,000 units. Division beta is making a profit, guys, highest contribution at 5,000 units. Division beta will manufacture and sell 5,000 units of product BZ. Now, this implies division alpha will manufacture and transfer 5,000 units of component AX component AX at a transfer price of, at a price of 40 rupees. Division AX is also going to make a profit at this level. समझ में आया बेटा ये? इसके बाद में we will do profitability statement. All of you copy this part, guys. This is just determining the profit maximizing selling price. I hope you've understood this, guys. If you are done with this part, beta, please go ahead as such, guys. Finish off the next part, beta. Yes, guys, all of you better do this. Yes, guys, are you all done with this? Now you will be like, sir, anyways, we cannot respond to you. But then, guys, if I keep saying this, you will get a feeling that, you know, you are sitting in the class. I hope you're all done with this, beta. Your final part. Just in case you're not done with it as such, but you can pause the screen. We will now do profitability under this. Yes, beta. I hope you're all done with this. Yes, sir, we are all done with this. Now let us do profitability, guys. Just in case you're not done with it, beta, please pause and copy. Profitability statement, guys. Profitability statement. Division alpha, division beta, and total company, guys. I'll write better revenue. External sales as such, guys, is only for division alpha, that is 5,000 units at a price of 90 rupees. 5,000 units at a price of 90 beta was 4,50,000. Internal transfers beta was for division alpha, 5,000 units at 40 rupees, that is 2 lakhs. Your overall external revenue as such beta would only be 4,50,000 from the viewpoint of the company, less variable cost as such, guys. Cost incurred excluding this internal transfers. First division is selling 5,000 into 12 beta 60,000 rupees. यहाँ पे 5,000 into 8 as such beta 40,000. Overall company as such beta is incurring a variable cost of 1 lakh. Transfer price as such, guys, internal transfers 2 lakh rupees. 2 lakh rupees. Overall company will only be that, guys. You talk about contribution as such beta here. First division is making a contribution of 1,40,000. Second division, guys, is making a contribution of 2,10,000. Put together 3,50,000. Look at the amount of the specific fixed cost beta that they are incurring. First division beta was incurring a fixed cost of 60,000. You can do it with me, guys. This is normal 90,000 and 1,50,000. You'll be like, after all of these questions, this is so simple. So this beta would be the amount of profit that we are making. This is 80,000. This is 1,20,000 and this is 2 lakh rupees. This is the amount of profit, guys, that the company as a whole is making when they're operating at a volume of 5,000 units. When they are operating, guys, at a volume of 5,000 units. Now this answers your first bit, guys. We will now be proceeding to the second bit. For the second bit. Copy karo beta here. All of you guys copy this quickly. I'll wait for a minute, guys. I hope you're all done with this, guys. नहीं हुआ तो again you know better that you're supposed to pause and do it. Are we clear? Yes, sir. Let us look at the second bit of the question, guys. It says, find out the profit maximizing output from the sale of product BZ for the active multinational limited. Profit maximizing output from the sale of products BZ for the company, guys. For the company. Be careful, guys, whatever we are reading. Find out the profit maximizing selling price from the viewpoint of profit maximizing output from the viewpoint of company. Profit maximizing output beta from the viewpoint of company. So we are basically ignoring, guys. We are basically from the viewpoint of company. Remember, guys, we will be ignoring the fact as such, guys, that there are internal transfers. Ignore divisional boundaries. Ignore divisional boundaries as such, guys. The total variable cost to the company is how much? Total variable cost to the company. Ultimately, guys, the company as a whole as such beta is incurring a variable cost of only 8 plus 1220 rupees. Ultimately, guys, the company as a whole beta is incurring a variable cost of only 8 plus 1220 rupees. Yes or no, guys? We will now compute profit maximizing selling price based on this beta. This is what we do, guys. We are ignoring the capital. We are ignoring this beta. Yaad hai nahi hai, guys? I told you beta under dual rate transfer pricing policy, that if the purchasing division, guys, if the receiving division is basically showing the amount of input at marginal cost, then it would result in optimum decision making, because ultimately we are taking marginal cost from the viewpoint of the entire company. There's no opportunity cost here, guys. There is no opportunity cost, guys. So we can directly take total variable cost to the company. Remember beta, there is no opportunity cost. Understood, sir. So guys, the demand as such beta here can range, can be 2000 units. करो बेटा सब लोग साथ में 2000, 4000, 5000, 6000 and 7000, 8000. This is the demand, guys. The selling price is 120, 100, 90, 82, 70, 65. The contribution per unit, guys, at all of these beta would be 120 minus 20 is 100. 100 minus 20 is 80. 90 minus 20 is 70. 82 minus 20 is 62. 70 minus 20 is 50. 65 minus 20 is 45. You can multiply, guys, all of this with the contribution per unit beta. 2000 into 100 is 2 lakhs. This is 4 lakh. 4000 into 80, guys. 4000 into 80 beta would be 3 lakhs 20,000. 5000 into 70 is 3 lakh 50,000. 6000 into 62 beta is 3 lakh 72,000. This is 3 lakh 50,000 again. 8000 into 45 beta should be 3 lakh 40,000. No, 3 lakh 60. ये क्या हो यार? Profit बढ़ रहा है. So was this correct? 8000 into 17 is 1 lakh 36. Yes, guys. Anyways, beta, these are your this is the profit maximizing output, guys, from the viewpoint of the entire company as such beta. It should be operating at a volume of 6000 units. From the viewpoint of company, the optimum output level is how much, guys? From the viewpoint of company, optimum output level is 6000 units. The optimum output level beta is 6000 units. Understood, sir? Please write, guys. Please write better. मतलब you were doing it with me, of course, guys. I'm just going to wait for a minute. बहुत time ले लिया बेटा question के लिए अपन. Of course, बेटा, we also revised a lot of earlier things. Yes, beta, I hope you're all done with this. I hope you're all done with this, guys. Chalo, beta. The third bit, guys, now. Third bit of the question, guys. In case you're not done with it, please pause and do it. Calculate using the marginal cost of component AX as the transfer price. The monthly profit that would be earned as a result of the selling price by product BZ. You know, guys, that if transfers are based on marginal cost as such, guys, if transfers are based on marginal cost, the ये अपन जो ऊपर अभी compute करे बेटा, this itself will hold good as such, guys. The profit maximizing output beta that division BZ will select beta is 6,000 units, because even this is based on marginal cost only. Yes or no? If transfer price beta is equal to marginal cost as such beta, and that is 12 rupees. The output, guys, the output that BZ will manufacture and sell, that beta, division beta, guys, I'm so sorry, that division beta, guys, will manufacture and sell beta is 6,000 units. Same calculation as above beta, same calculation as requirement B. Isn't that based on marginal cost, guys? The total marginal cost beta, the total marginal cost beta to division beta, guys, is 12 rupees plus 8 rupees, 20 rupees, because the transfer price beta is 12 rupees. You can do this on your own beta now. You can do this on your own. You just have to compute a profitability statement. Now, isn't this a very simple question, guys? Profitability statement, guys. Remember, output is 6,000 units. Output 6,000 units beta, and transfer price is 12 rupees. Transfer price is 12 rupees. So there is division alpha, there is division beta. Alpha, beta, and the overall company. Revenue mein beta, as far as your external revenue is concerned, external revenue, the other division is going to sell 6,000 units, guys, at a price of 82 rupees. 4,92,000. Internal transfers, guys, will be 6,000 units at 12 rupees only. That is 72,000. Overall revenue of the company beta will be 4,92,000. Less beta variable cost. Your external cost, guys, or cost incurred as such beta excluding internal transfers. This division beta would have incurred 12 rupees only. This division would have incurred 8 rupees, guys, excluding internal transfers. Internal transfer beta apart from this is 72,000. So the overall company as such beta is incurring a cost of only 1,20,000. Now you talk about contribution as such, guys. Contribution of division alpha is obviously 0, guys, and here beta they are making a contribution of 4,20,000. 4,20,000. Sorry, guys. 4,92,000 minus 48 minus 72. 3,72,000, guys. 3,72,000. Now, if you deduct the amount of specific fixed cost beta of this project, here there's 60,000. Here there's 90,000. Here there is 1,50,000, guys. So all of this beta would result in a negative profit of 60,000, guys, for division alpha. His profitability is getting impacted. 2,82,000, guys, for the other division. Sorry, overall company beta will be 2,22,000. You see, guys, earlier beta the overall profit of the company was 2 lakh rupees, but now if they're operating at a volume of 6,000 units, overall profit of the company will be 2,22,000. But let us not forget beta that division alpha will not be comfortable with this. Division alpha's performance, divisional performance, is being measured on the basis of return on investment. and this loss of 60,000 as such beta would impact the performance of division alpha. Undoubtedly 6,000 units is the optimum level of output from the viewpoint of company, but division alpha will not be motivated, guys. If you start doing, if they start transferring, if they start forcing better transfers at marginal cost, division alpha might not even be interested in expansion of capacity, guys, on a later date, because he knows better that there's no point, anyways he'll be incurring losses. He will not be motivated to save cost or anything, guys. Copy karo beta ye. All of you better finish this. I hope you're all done with this beta. Let us move to the next bit, guys. Last bit of this question. The operation head of the company requires internal transfers between the divisions at marginal cost from the overall company's perspectives. If marginal cost is used as a transfer price, the manager of division alpha will not be motivated, as there will be no incentive to the division guys to transfer components internally. What transfer pricing policy, guys, would you suggest to help the company overcome the conflict between optimum decision making and performance evaluation? Overcome the conflict, guys. You can talk about the conflict problem. So whenever they give bits like this, guys, normally beta, whenever they talk about conflict resolving problem, guys, please mention both the methods. But I told you that it is very important from the viewpoint of comments. Write about dual rate transfer pricing policy, write about two-part transfer pricing policy. Okay? This is what you're going to do. Let us not, I'll just write beta brief. Do not forget beta the divisional performance is being evaluated. ये लिख सकते हो बेटा मेरे साथ, अभी थोड़ी देर पहले पढ़ाया था. Divisional performance is being evaluated on the basis of return on investment, return on capital employed. If transfers happen at marginal cost, division alpha will incur a loss as such beta, thereby affecting his own divisional performance. He will not be motivated to manufacture and transfer, guys, transfer outputs as such beta, to units, guys, to division beta. Also, guys, this will impact the future performance of the divisions. इतना लिखना है बेटा. Divisional performance is being evaluated is being evaluated on the basis of return on capital employed, return on capital employed, return on capital employed, guys. ये लिखो बेटा सब लोग. If transfers are made at marginal cost, if transfers are made at marginal cost, division alpha will incur a loss. Division alpha will incur a loss. Will incur a loss, thereby affecting divisional performance. Thereby affecting divisional performance. Divisional performance. Okay, sir. And also, guys, this will affect divisional performance, no doubt about it. Division alpha will not be motivated. Will not be motivated. Division beta has an advantage. Division beta has an advantage. The overall output should remain at 6,000 units. Overall output should remain at 6,000 units. Should remain at 6,000 units from the viewpoint of the company. From the viewpoint of the company. Now, guys, the following two methods can be used to resolve conflict. The following two transfer mining methods better can be used to resolve conflicts. You will have to explain them better in a detailed manner. Dual rate transfer pricing system and two-part transfer pricing system. Dual rate transfer pricing system and two-part transfer pricing system. This is what they can do, guys. You'll have to explain, guys. Explain in exam. ऐसे ही नहीं करना है. You can same as question number 27. Answer same as question 27. वहाँ पे दिया हुआ है ना बेटा answer to question 27. You can write that. But this is the answer, guys. I hope you're all clear about this, guys, and there is no problem. Yes, sir. Very clear. I'll just wait for 30 seconds, better, just in case you guys missed out any point, and then we will continue after that. I hope you're all done with this, guys. So that was an easy question, beta, for 20 marks. That was a very, very simple question, beta, for 20 marks. I believe, beta, that was like giving away free marks to the students, guys. Unless, of course, beta, you mess up with the comments part in the last bit. Last bit में बेटा comments में बेटा you do not have to use your brain, you just have to write the same content as such बेटा that is being discussed in the class. You do not have to do anything else. Question number 29 guys, please ignore the solution given as such guys. This question was asked in May 2018 beta for 20 marks. This question was asked in May 2018 beta for 20 marks. G Limited is a multi-product manufacturing concern functioning with 4 divisions. The electrical division of the company is producing many electrical products including electrical switches. The division functioning at its maximum capacity sells its switches in the open market at 25 rupees each. Variable cost per switch of the division is 16 rupees. Point to be noted, maximum capacity guys, functioning at its maximum capacity. There is no spare capacity guys. You are selling in the open market at 25 rupees each. Variable cost is 16 rupees. You are selling this switch in the open market at 25 rupees. Variable cost is 16 rupees. The household division, another division of GL Limited, is functioning at 70% capacity. It had asked the electrical division to supply 5,000 switches per month at a rate of 18 rupees each to fit in the night lamps produced by it. So guys, electrical division has asked the household division guys to supply switches at a price of 18 rupees. The same switches guys that household division is basically selling in the external, the same thing but that electrical division guys is selling in the external market at 25 rupees. If you go by the concept of transfer pricing and goal congruence guys, minimum transfer price should be equal to your external market price, and that is 25 rupees. Minimum transfer price beta should be equal to the external market price, that is 25 rupees, because guys there's an opportunity cost. That's like writing variable cost plus opportunity cost beta 25 rupees. The total cost per night lamp is being estimated as detailed below. Components purchased from outside supplier will be 50 rupees. Switches if purchased internally beta would be 18 rupees. Other variable cost of 40 rupees. Fixed overheads are 21 rupees. Total cost per night lamp as such beta is 129. The household division is marketing night lamps at a price of 130 rupees each. Their total cost beta is 129. They're selling it at 130. Let us not forget that this includes fixed overheads of 21 rupees. Let us not forget that the overall cost includes fixed overheads of 21 rupees. So the household division is marketing night lamps at a price of 130 rupees each with a very small margin, as it is doing business in a very competitive environment. Any increase in price made by the division will push out the division from the market. Therefore, the division cannot pay anything more to the switches if they keep the electrical division. So guys, they are taking a decision on the basis of total cost. On the basis of total cost as such beta, they come to a conclusion that they will not offer anything more than 18 rupees. Further, the manager of the division informed that it is very much essential to keep on the market share for night lamps by household division to retain the experienced workers, guys, of the division. The company is using ROI as a scale to measure the divisional performance, and also marginal costing approach for decision making. Marginal costing approach beta for decision making. Important points as such guys here, very very important points in the last two sentences. Marginal costing approach as such beta would still include your opportunity cost. You cannot simply transfer at 16 rupees as such guys, that would be detrimental to the divisions as such guys. Would you recommend ये marginal costing approach for decision making beta is also better, that please do not consider fixed costs, they're all common costs as such beta, you should not be taking that into consideration. Would you recommend the supply of switches to household divisions by electrical divisions at a price of 18 rupees each? Substantiate your recommendation with suitable reasons. 5 marks. Analyze whether it would be beneficial for the company as a whole to supply the switches to household division at a unit price of 18 rupees by electrical division. Do you feel that the divisional managers should accept the interdivisional transfers in principle? If yes, what should be the range of transfer price? Suggest the steps to be taken better by the chief executive of the company to change the attitude of the divisional heads if they are against interdivisional transfers. Last bit to better, if they say what actions should be taken, they will write about this only. कुछ change नहीं करेंगे. Okay, sir. Now, guys, what is more important beta is you reading the question once, guys, and then we answering it collectively. All of you beta go through the question. फटाफट question पढ़ो बेटा ठीक से. Yes, guys, I hope you're all clear about this. Let us now write the given information, guys, first, and then we will attempt the answer. The question is pretty simple, guys, no complications. Again, a very simple question coming in the examination. They give questions like this only better in the examination. All the questions in the examination are pretty simple, guys. November 2020 का of course was nice, but the 10 mark question that came in the exam. बाकी पूरे तो guys ठीक है. And all the answers to the additional questions, guys, will be uploaded in the same link as the lecture files as such, guys. I will be doing that. Maybe, guys, by the time you view these classes as such, guys, a lot of you people are viewing these classes. You'll already have the class. You'll already have all the answers to the additional questions. So, anyways, better coming to this question number 29, guys. We're first talking about electrical division. We're talking about electrical division, guys. Electrical division as such, better. The product that we're talking about, better, is electrical switches. Electrical switches. These electrical switches as such, guys, there is no spare capacity. There is no spare capacity. Variable cost per unit is 16 rupees. Selling price per unit is 25 rupees. So yes, contribution per unit on external sales is 9 rupees. Okay, sir. Okay, sir. As far as your दूसरा कौन है बेटा ये household division is concerned, household division is concerned. So they are now manufacturing a product called as night lamps. Product called as night lamps. Yes. Product night lamps. Total quantity beta is 5,000 units. 5,000. If you talk about their variable cost per unit beta, variable cost per unit. External cost beta would be 50 plus 40, 90 rupees. External cost beta is 50 plus 40, 90 rupees. Plus whatever is the transfer price. This would be the total variable cost beta. Total variable cost. The selling price per unit as such, guys, is going to be 130 rupees. 130 rupees. Fixed cost allocated, guys. Fixed cost allocated is 21 rupees. 21 rupees. This is the information, guys, for household division. Okay, sir. And also let us not forget the fact that performance is evaluated. Performance is evaluated based on ROI. It is not that these divisions are working as cost centers better. If they're working as cost centers, they will have no problem at directly transferring at cost. Is evaluated based on ROI, return on investment. Anything else? One more important point that they've given us, better, that there are experienced workers. They want to retain. Household division wants to retain experienced workers. Household division wants to retain experienced workers. All right, sir. समझ में आ गया सर. कॉपी करो बेटा सब लोग. All of you copy this, guys. Finish off this beta first. ये given information लिखो, then we will attempt all the bits, guys, whatever are the requirements. Chalo guys. Now, but if you look at the first bit as such, guys, it says, would you recommend the supply of switches to the household division by electrical division at a price of 18 rupees each? Let us not forget, guys. Let us not forget, beta. The opportunity cost. If you look at the opportunity cost as such, guys, then the opportunity cost as such, beta, for the household electrical division, guys, is 25 rupees. Yes or no? So obviously electrical division, guys, is not going to accept it, because this would result in a decline in profit of electrical division, guys, which in turn, beta, would result in a lower divisional performance. They have an opportunity cost. But then, beta, if you think from the viewpoint of the household division as such, guys, household division, क्या होगा बेटा is that they might make a higher amount of profit, but then this division as such, guys, this might not result in an optimal decision making from the viewpoint of company as well. ठीक है बेटा, write down the answer. Write down the answer, guys, to the requirement. First requirement, guys. Electrical division has no spare capacity. Any internal transfers? सब लोग साथ में लिखो बेटा. This is a very normal question. Any internal transfers will be made by reducing external sales. Hence the minimum transfer price would be variable cost plus per unit plus opportunity cost. 16 plus 9, beta, 25 rupees per unit. Now, the quoted transfer price is 18 by household division. Yes or no, guys? So, guys, if you take this as into consideration as such, beta, remember that this is not based on your not based on opportunity cost. This would result in lower profits and lower ROI and lower return on investment for the electrical division. Yes or no? Yes, sir. This would result in lower profits and lower return on investment, beta, for the electrical division. Also, it is below opportunity cost. It is below minimum transfer price. Will not result in optimum decision making. It will not result in optimum decision making from the viewpoint of company. It will not result in optimum decision making. समझ में आ गया sir. I hope you were all writing it with me only, guys. In case you're not done with it, please pause the screen and copy this bit. I'm zooming in and I'm zooming out. In case you're not done with it, you can pause the screen, guys, and copy. I am zooming in and then I will zoom out now, guys. Okay, yes, sir. Second bit, guys. Better. Analyze whether it would be beneficial to the company as a whole to supply the switches to the household division at a unit price of 18 rupees by electrical division. So, guys, from the viewpoint of the company, whether it is beneficial or not as such, guys, we will see, guys. Let us just analyze as such, beta, कि क्या होगा. Sorry, how will you answer this as such, guys? We will forget the fact as such, guys, as to what is the amount of fixed cost that they are absorbing. The relevant cost of manufacturing, guys, for division, कौन सा बताइए? Division household. Fixed cost is not relevant. Yes or no? Yes, sir. At a transfer price of 25 also. Their variable cost per unit, guys, would be 50 plus 40 external cost plus 25, guys, 90, 115. Selling price per unit, guys, is 130. Household division, guys, is still making a profit of 15 rupees per unit. Household division is still making a profit of 15 rupees per unit. Yes or no? So please understand, guys, if transfers are made, if transfers are made, if transfers are made, guys, at 25 rupees, there will be no loss of profit. It is not that whether the first division is making more profits. There will be no loss of profits. There will be no loss of profit beta for electrical division. For electrical division. And the household division would additionally make, the household division would additionally make 15 rupees per unit. Would additionally make 15 rupees per unit. Yes or no? So समझ में आ रहा है सर? Yes. So this as such beta, this would be beneficial. This would be beneficial from the viewpoint of the entire company. Beneficial from the viewpoint of the company. Let us not forget the fact as such, guys, from the viewpoint of company. ये अपना जो household division है, guys, household division is operating at only 70%. Household division is operating at only 70%, guys. So let him recover beta. It can also lend its skilled labor beta. It can also lend its experienced workers to other divisions. Experienced workers as such, guys, to other divisions. This would be the answer. They said 18 beta, we are taking a transfer price of 25 rupees and we're proving it that they're still making a profit of 15 rupees per unit, guys. 15 rupees per unit. Understood, sir? Yes, sir. Please, zooming in as such, guys. I will not be giving you much time, only a minute as such, guys. Please finish this. We will answer the third bit after this. Yes, beta, here in this point. Chalo, guys, I hope you're all done with this. Now, if you look at the third bit, guys, if you look at the third bit beta here, it says, do you feel that the divisional managers should accept the interdivisional transfers beta in principle? If yes, what should be the range of transfer price? Simple beta here. You all know, guys, that how do you decide the range of transfer price beta? We've already computed the minimum transfer price. We already computed the minimum transfer price beta to be variable cost per unit plus opportunity cost, which came up to 25 rupees. Yes or no? Yes, sir. Maximum transfer price beta from the viewpoint of the receiving division, guys, would be the lower of net marginal revenue and external supplier price. We do not have external supplier price here, but we can always compute net marginal revenue. The net marginal revenue beta, net marginal revenue for division, for household division, guys, for household division would be the selling price as such beta is 130. The variable cost per unit, guys, of course, excluding switches beta. Incremental cost lena hai, guys, excluding this component. So they are incurring, guys, other components. 90 rupees hai beta. So yes, and that is 40 rupees. I've already written beta as to what is the amount that they're incurring. So the net incremental revenue, guys, apart from that switches, guys, by using switches beta is 40 rupees. So the range of transfer price as such beta. The range of transfer price as such, guys, is 25 to 40. 25 to 40 as such, guys. So if the actual transfer price is in this range, if transfer price beta, if transfer price is in the range of 25 to 40, the divisional managers should accept it in principle. The divisional managers should accept it in principle as decision beta. मतलब वो चुपचाप accept कर लो, अभी तुम्हारा मुंह नहीं खोलोगे तुम लोग. You will not open your mouth. This will be the final answer. That this will be the final transfer price. Divisional managers should accept it. Should accept it in principle, as it will result in optimum decision making. As it will result in optimum decision making. समझ में आ रहा है sir? Yes sir. If the transfer price optimum decision making anywhere between 25 to 40 rupees as such, guys, would result in optimum decision making from the viewpoint of company, guys, not just from the viewpoint of these divisional heads. Understood sir? Copy the last bit, guys. C bit, fourth bit का answer तो वहीं पे है, guys. Already answer is already given there, guys. All of you do this, guys, quickly. Yes, guys. I hope you're all clear about this. I hope you're all clear about this, guys. There's no doubt. Last जो question है बेटा, that is the normal question, theory question as such guys. That is if to change the attitude as such better of divisional heads. So for that purpose as such guys, they can obviously implement the dispute resolving transfer pricing system. Okay sir. Question number 30 guys now. Given an RTP, also an ICI study material guys. Again better, this question if they given the examination has to be for 20 marks. Good question guys. Thoda bada hai, but then they're all nice guys. All nice questions guys. Chalo guys, let us read question number 30. Great Vision manufactures a wide range of optical products including lenses and surveillance cameras. Division A manufactures the lenses while Division B manufactures surveillance cameras. The lenses that Division A manufactures is of standard quality that has a number of applications. Due to huge demand in the market for its products, Division A is operating at full capacity. Just like the previous question, but here Division A is operating at full capacity. It sells its lenses in the open market for rupees 140, whereas the variable cost of production is 110. Total cost of production is 125. The variable cost of production is 110 as such guys. Total cost of production is 125 including apportionment of fixed cost, whereas the selling price of the lens is 140 rupees. The total production cost of a camera by Division B beta is 400 rupees. Currently Division B procures lens beta from foreign vendors. The cost per lens beta would be 170 each. They're procuring it from an external market beta at 170 rupees. On the face of it beta, without reading forward, the company as a whole will lose guys. Sir, how are you concluding? Our external price beta, the first division is selling in the external market beta at 140 rupees. The first division guys is selling in the external market beta at 140 rupees. So your minimum transfer price beta, which is variable cost plus contribution per unit, the minimum transfer price guys, which is variable cost plus contribution per unit, should be 140 rupees. Yes, yes. The maximum transfer price beta is the lower of net marginal revenue and the external supplier price, that is working out to 170 rupees. We'll see what is net marginal revenue. Based on this beta, the other division is procuring at 170 rupees. So we are selling at 140 and our own division is buying at 170 rupees from the external market. Company as a whole beta is losing 30 rupees. Company as a whole beta is losing 30 rupees, which is not correct. It is proposed beta that Division B guys should buy an average of 5,000 lenses each month from Division A. From Division A guys at 120 rupees per lens. Now Division A beta will say, am I looking like a fool? I am selling this product in the market at 140 rupees and you are telling me that I have to transfer it to the other division at 120 rupees. Not possible, get lost. ऐसे बोल रहा हूँ बेटा, ऐसा बोल सकता है वो. The estimate cost of a surveillance camera is as below. Other components purchased from external vendors beta is 150 rupees. Cost of lens purchased from Division A guys is 120 rupees. Other variable cost beta is 30 rupees. Fixed overheads are 50 rupees. Total cost of a camera is 350. Each surveillance camera is sold for rupees 410. Let us not forget beta that this 410 is based on a transfer price of 120, which Division A might not be willing to transfer at. The margin for each camera is low since competition in the market is high. Any increase in the price of the camera would reduce the market share. Therefore, Division B cannot pay Division A beyond 120 per lens procured. Why can't you pay, Ray? Even if you're paying more, you will still be able to make a profit. Great Vision's management uses return on investment as a scale to measure the divisional performance and marginal costing approach for decision making, just like the previous question. Analyze the behavioral consequences of each division. Analyze the behavioral consequences of each division when Division A supplies lenses guys to Division B at 120 rupees per lens. Analyze if it would be beneficial to the company as a whole for Division A to supply the lenses at 120 rupees. Do you feel that the divisional managers should accept the interdivisional transfer prices in principle? If yes, calculate the range of transfer price. Advise the alternate transfer pricing methods. Calculate the range of transfer price if division has excess capacity and can accommodate the internal requirement of 5,000 lens per month within the current operations. So isn't this an exact copy of the previous question? Yes sir, it is an exact copy of the previous question. Similar question guys. I would want all of you guys to go through the question once, but quickly read the question guys. All of you better read the question number 30 guys, and then we'll start off with the answer. Please go through the question, guys. All of you read the question properly, beta. Chalo, guys. I hope you're all done with reading the question, guys. It's a copy of the previous question, beta. I will write the information, or let us all collectively write the information as such, beta. साथ में करते guys. Simple question है. We will all do it as such, guys. Question number 30, guys. So here, guys, first thing beta is that there is division A, manufacturers lenses, manufacturers lens. Yes, there is no spare capacity. There is no spare capacity. Variable cost per unit beta is 110. The selling price per unit is 140. Contribution per unit is 30. Full cost per unit is 125. 125. Division B, guys. This manufactures what beta? Surveillance cameras. Manufactures cameras. Okay. Now they want to buy 5,000, guys. Requirement beta is 5,000 lenses. 5,000 lenses. If you talk about their variable cost per unit beta, variable cost per unit, other than lens, other than the lens as such beta that they are going to pay for as such, guys, other than lens, कितना है बेटा other than lens? 150 rupees. हाँ 30 rupees. 150 beta plus 30, 180. Okay. Now variable cost per unit, guys. For them beta lens from external market as such beta is at a price of 170 rupees. From external market is at a price of 170 rupees. Okay, sir. Their selling price per unit as such beta is 410 rupees. Selling price per unit beta is 410 rupees. Divisional performance. Divisional performance, guys, is evaluated on the basis of ROI. Divisional performance is evaluated on the basis of ROI, return on investment. ठीक है? हाँ sir. So you can obviously, guys, I'm zooming in only for 30 seconds, beta. You must have written it with me. You must have written it with me, guys. I hope you're all clear about this. I hope you're all writing this, beta. सबका हो गया ना ये? हाँ sir, हो गया है. ठीक है, guys, great. So divisional performance is evaluated on the basis of return on investment, guys. Now we will talk about bit 1, guys. It says, guys, analyze the behavioral consequences. Slightly different from the previous bit as such, guys. हाँ, but उनको acceptable रहेगा नहीं रहेगा as such, guys. First bit as such beta talking about behavioral consequences. Analysis of behavioral consequences. First thing, guys, let us think from the viewpoint of division A, guys. Let us not forget beta that division A is operating at full capacity, but if division A is operating at full capacity as such guys, and they're forced to transfer at 120 rupees per lens as such guys, it would mean beta that they have to that their overall profits would reduce by 20 rupees per lens beta into 5000 lenses, 1 lakh rupees. This in turn as such beta would reduce their contribution per unit to only 10 rupees from 30 rupees, and overall profit or loss guys on full cost would be a loss of 5 rupees. This would affect the return on investment guys. If the overall company is making a decision regarding production expansion guys of this thing guys division, they might not want to expand the capacity by looking at the loss figures as such guys, where in fact as such beta this division can actually make good amount of profits. So that is the impact as such guys. Division B to beta khushi khushi karega if he's procuring from external market as such beta his overall variable cost beta would be 350, full cost is 400 rupees, and is making a profit of only 10 rupees, contribution of 60 rupees. But then if he's able to get internal procurement at 120 rupees as such guys, remember his overall contribution will increase as such guys to 110 rupees, and then beta his profit will increase guys to 60 rupees. 10 plus 50, 60, yeah. So he will obviously be very happy guys about the fact that he's able to get it 120 rupees. We all know the answers to this guys, we just have to write it properly. Likho guys, analysis of behavioral consequences. Just because the answers are given there beta, please do not be like I am not going to write this, I am going to ignore this. Do not do that as such guys, do it. All of this is for the purpose of our understanding. It is not that beta you are all experts of the subject, or even if you are as such guys, remember we still have to write the exam. Let us put in effort, guys. So analysis of behavioral consequences beta here. The first one as such beta here is division A has no spare capacity, external sales result in a contribution of, सब लोग साथ में लिखो बेटा, external sales result in a contribution of 30 rupees per unit and a profit of 15 rupees per unit. If internal transfers are made at 120 rupees, the contribution per unit beta will reduce to 10 rupees, 120 minus 110, and division A beta would be making a loss of 5 rupees per unit, 120 minus 125. समझ में आ रहा है guys? Yes beta. This would impact the divisional performance of division A, This would impact the performance of division A, leading basically beta due to lower ROI, leading to low ROI, guys. Such low ROI reported can result in suboptimal decision making. As the top management might not expand the capacity of division A due to lower reported ROI. In fact, the ROI is more only as such guys, but because you're reporting it less on account of internal transfers at 120 rupees guys, this will get impacted. I hope you're all writing this guys. I'll wait for 10 seconds. I'm zooming in as such guys. तुम लोग का नहीं हुआ तो pause करके copy कर लो बेटा. Any part that you're not done as such guys, you can pause and copy. Any part better that you're not done, you can pause and copy guys. Check करो बेटा सब लोग. All of you guys check this. Okay beta, I'm assuming that you're all done with this. Now, if you talk from the viewpoint of division B guys, if division B procures lens from external market at 170 rupees, from external market beta at 170 rupees. लिखो बेटा सब लोग साथ में. I've explained this. At 117 rupees, 170 rupees, the total variable cost per unit beta would be, other than lens beta, it is 180 rupees, so this would be 180 beta plus 170, 350. The total cost per unit beta would be, the total cost per unit would be variable cost beta plus fixed cost, 350 plus 50, 400 rupees. At selling price of 410, at a selling price of 410, division B beta will generate a contribution of 60 rupees per unit, will generate a contribution of 60 rupees per unit and a profit of only 10 rupees. Division B beta would generate a contribution of 60 rupees per unit, guys, and a profit of only 10 rupees. Understood? Yes, sir. If internal transfers are priced at 120, the total variable cost of division B will be 180 plus 120 beta 300, and the total cost beta will be 300 plus 50, 350, resulting in a contribution of 110 and a profit of 60 rupees per unit. Therefore, division B beta will accept a transfer price of 120. समझ गए बेटा? This is analysis of the behavioral consequences. Understood, sir? How are they going to behave? Please copy this, guys. I'm zooming in as such, guys. You can pause and copy this. I'm zooming in better. You can pause and copy this. I hope you're all clear about this. समझ गए, sir? Yes, sir. समझ गए. Now, guys, the second bit, guys. Let us look at the second bit. It says, analyze if it would be beneficial to the company as a whole, guys, for division A to supply the lenses to division B at 120 rupees per lens. Analyze, guys, from the viewpoint of company as such, guys, if it is beneficial as such, guys. If it is beneficial. पहले तो बेटा ये देखो. So if division A supplies, we know, guys, if division A supplies the lens at 120 rupees, division A beta will lose a contribution of 20 rupees. Yes or no? 20 rupees. 140 beta minus 120. So in overall beta, 5,000 into 20 as such beta is 1 lakh. Division A beta will lose 1 lakh. Division B as such, guys, will save 50 rupees per unit. How 50 rupees per unit? Their external cost is 170 as such beta, but then they're now able to procure at what price? The transfer price as such beta is only 120. So their saving as such beta would be 5,000 into 50 rupees as such, guys, 2 lakh 50. The net savings to the company, guys, the net savings as such beta to the company, guys, is 2,50,000 minus 1 lakh, guys, that is 1 lakh 50. Now, irrespective of transfer price, guys, internal transfers should be made. As a company as a whole, should be made guys, as the company as a whole beta will save 1,50,000. मैं यहाँ पे minimum transfer price and maximum transfer price नहीं लिखा बेटा. I did not write that because I will have to write that beta for the third bit. You can also answer this better by using the concept of minimum transfer price and maximum transfer price. Minimum transfer price is 140, maximum transfer price is 170. If internal transfers do not happen, forget the transfer price. We do not care what is the transfer price, but if internal transfers do not happen, guys, the company as a whole will lose this difference of 140 and 170, 30 rupees per unit. On 5,000 lenses, that is 1,50,000 rupees. So internal transfers should be made as a company, as the company as a whole better will save 1,50,000. This is the answer to the second bit. You guys can copy this. Answer to the second bit बेटा copy कर लो ये. I hope you're all copying this, guys. Okay, guys, I am assuming that you're all done with this, guys. Let us look at the third bit better now. Third bit. It says, do you feel that the divisional managers should accept the interdivision transfers in principle? If yes, better, what should be the transfer price? They will accept they should accept, guys, the transfer price in principle if the transfer price is between the minimum transfer price and the maximum transfer price limits. Yes, sir. Our minimum transfer price as such, guys, will be variable cost plus unit plus क्या बेटा ये अपना opportunity cost. Let us not forget बेटा that they have full external demand, so 140 rupees. Maximum transfer price, guys, should be the lower of net marginal revenue and external procurement price. External procurement price, guys. What is the amount of net marginal revenue, guys? The selling price per unit beta is 410 less variable cost per unit beta excluding lens. Excluding lens beta, the variable cost per unit is 180 rupees. So that marginal revenue as such, guys, is 410 minus 180, guys, 230 rupees. 230 rupees. Whereas the external procurement price as such, guys, external procurement price is 170 rupees. Is 170 rupees. So this is the case beta. The range, maximum transfer price beta will now be maximum transfer price will be the lower of 230, guys, at 170, that is 170 rupees. Therefore, beta, the range of transfer price is such, guys, would be 140, guys, to 170. Range of transfer price beta is 140 rupees, guys, to 170. The divisional managers divisional managers should accept the transfer price in principle, should accept better the transfer price in principle if it is between 140 to 170. You can also say, guys, just for our understanding, beta note likha raha hu, just for our understanding. If internal transfers are not made, company as a whole loses. Company as a whole beta will lose. Company will lose 30 rupees per unit. 30 rupees per unit, guys. 170 or 140 ka difference. Total loss as such beta would be 5,000 units into 30 rupees, 1,50,000. 5,000 units into 30 rupees, beta 1,50,000. This would be the total loss beta that the company would incur. Understood, sir. Please make a note of this, guys, now. All of you better make a note of this. This is the answer to the third bit, guys, whether they should accept the transfer price in principle or not. Yes, they should accept the transfer price in principle if it is between the minimum transfer price and the maximum transfer price. I hope you're all done with this beta. Now guys, let us move to the fourth bit. Fourth bit beta is a theory question. You guys will be able to answer that. Fourth question beta is again a normal question guys. Dual rate transfer pricing. Dual rate and two-part transfer pricing systems. Two-part transfer pricing systems. Understood sir. Fifth bit beta, if you say question kuch bhi nahi hai beta, it's asking us to compute range of transfer price beta in the fifth bit. If division A has excess capacity and can accommodate guys the internal requirement of 5,000 lens per month within the current operations. So guys, in the fifth bit beta, spare capacity is available. Spare capacity is available. So there's no opportunity cost of internal transfers. There is no opportunity cost. Likh lo beta, it's a very simple one. No opportunity cost beta of internal transfers. Because there is no opportunity cost of internal transfers beta, your minimum transfer price will directly be equal to your marginal cost per unit. Marginal cost per unit guys, that is 110. Maximum transfer price to beta we have already written. Maximum transfer price guys we have already written, that is 170. 170. Therefore the range of transfer price beta would now be 110 to 170 rupees. 110 to 170. This would be the answer guys. I'm zooming in as such guys. फटाफट देख लो. इसके बाद में we'll now start international transfer pricing. No guys, it is not as exciting as you think beta. This is not what we do under not the same that we do under income tax. I hope you're all done with this guys. नहीं हुआ तो pause कर लेना, ठीक है? Let us now move to the concept of international transfer pricing guys. First important thing beta is, please do not assume beta that we are doing the same thing that we're going under taxes. Of course, what is so different about international transfer pricing guys is what we will have to understand here. What is so different about international transfer pricing guys is what we will have to understand here. See guys, there are a lot of questions beta that you can ask yourself. Why do you think guys that a lot of global companies have set up their operations in India? Why do you think beta that Deloitte has a back-end office in India guys? Back-end office matlab guys, the Deloitte USI beta that is doing the audit work from India as such guys. The same US audit beta assurance work sitting in India as such beta. Why do you think that Deloitte has a operation in India? Why do you think guys that EY has such back-end operations in India? Why do you think guys KPMG has such back-end operations in India? The reason is simple guys. There is abundant talent as such guys in India. There is abundant talent in India. First most important factor. The second factor beta, lower wages in India. Of course, you cannot compare the wage in India guys with the wages in the US. But then imagine guys that if you are able to charge the customer in US, charge your clients in US beta in dollars, as per those, you know guys, typically beta $100 to $150 per hour is what beta a normal CPA would fetch. An experienced CPA beta goes up to $200 per hour also. So if you are able to charge $100 to $150 per hour as such guys to your client, and the amount of salary that you're paying as such guys to your Indian counterpart as such beta here in India is say barely 70,000 a month as such guys. If you divide that by the normal working hours of 200 beta, that is working out to 350 rupees per hour. That is $5 an hour. Of course, I'm not factoring in a lot of other factors beta. This is the entry level salary guys. There will be salaries being paid at a higher level as such beta. Plus there will also be guys a lot of infrastructure cost, a lot of other benefits that are being offered to the employees. Just as an example guys, say $5 की जगह $10 लगा लो या $20 लगा लो. What if your employee cost in India guys is $20 as such guys, but what if you are actually billing your client beta $100 in US? If you hire a CPA guys, if you hire a CPA beta in the US, an entry level CPA in US might fetch $80,000. 80,000. Good companies pay $80,000. As you gain experience guys, your salaries will only increase. So $80,000 is also a good pay as such beta there. So if they pay $80,000 per year as such guys, they are roughly paying divided by 2,400 hours. They're paying around $33 as such guys per hour of work. I am assuming 200 hours of work per month guys. So in US, but an employee might cost them $33. In India, it might cost him better $5 to $10 per hour. Do you see this huge differential, guys? Yes, sir. There is a lot of difference here. There is a lot of difference. That is the reason as such, guys, why these US operations would want to have their backend operations in India. Have backend operations in India. You might have also seen, guys, that whenever the global counterparts as such, guys, need the services of the Indian firms as such better. जैसे तुम लोग secondment पे जाते हो guys, a lot of people guys after qualification go on secondment guys, they go to London, they go to Denmark, they will go to guys a lot of places, European nations, KPMG के लिए बेटा European nations are pretty common और Middle East is pretty common guys, so they go on secondment to these places. The advantage बेटा is that if they are unable to recover the entire employee cost in India as such guys, they will send their employees on guys secondment, pay them Indian salary plus give them an allowance, but bill a higher amount guys to their counterparts, so they are making some amount of revenue here. Yes or no? So one reason beta as to why organizations can have their operations spread through multiple countries as such guys is that boss labor is cheaper in few countries. We all know guys that Philippines is also growing. BPO industry mein beta Philippines is actually growing as such guys. They are getting a lot of BPO work, business process outsourcing, the call centers that are operated. Just say beta Dell has a lot of their back-end operations in India. So first thing guys, I've explained this properly beta, that there's boss cheaper labor. I wouldn't cheap labor matlab kya guys, the wages are lower in India considering the standard of living, considering the cost of living in India as such guys. Okay sir, understood. Second reason beta as to why you have your operations across multiple countries is that your product actually has a demand in multiple countries. Your product has a demand in multiple countries. Coca-Cola will obviously have operations in India beta because there's a demand for Coca-Cola in India. Coca-Cola India beta pays royalty guys to Coca-Cola Global guys. Coca-Cola India will obviously pay royalty guys to Coca-Cola Global as such beta. So if there's an actual demand for your product as such guys, then obviously you'll want to set up your operations in multiple countries wherever wherever you have your products, and there will be some amount of transactions between the guys holding company and the subsidiaries that you set up in all of these subsidiaries that you are setting up at all of these locations. If there's a foreign bank operating in India guys, it means they see a potential in India. That is why they're operating in India. Yes or no? Yes sir. So that is another reason beta that there's an actual demand for your products as such guys. There's an actual demand for your products. Next beta, you might want to establish your operations in places where the raw materials are easily available, or where the raw materials guys can be procured easily as such guys. Just a lot of electronic manufacturing as such beta happens in China because raw material availability is not an issue, and we know guys if not China matlab wahan pe dekho guys, Taiwan as such beta has is leading in semiconductor chip industry. It is Taiwan as such guys, literally the entire supply in the world is made by them. So you will want to have your operations in South Asian nations guys, wherein the availability of raw material is more. That is why a majority of the US companies guys, electronic companies, will have their operations in China. India wants that raw material availability in India guys. India wants to grow that. Just India ka solar sector is growing rapidly as such guys, but then a lot of solar panels are imported from China. That is why government is now giving incentives on solar panel construction. We have seen that guys, Reliance has made an announcement of investing 75,000 crore rupees in the greener energy sector. Everything beta, they say from the basic raw material to the end product, Reliance will manufacture in relation to solar power. So guys, understand guys, if there's availability of raw materials guys, obviously you will want to have your operations in those areas guys where the raw materials are lower. So there are multiple reasons as to why your organization guys can have operations throughout the guys spread across nations. But having said that guys, if you have your operations as such beta spread across nations, you might want to use it to your advantage. You might want to use the fact beta that you have operations in multiple nations to your advantage. Just say guys, for example as such beta, say if India is a low tax country in comparison to the US, we know guys that the corporate tax rates have actually decreased in India as such guys. But aise socho beta, just as an example, I am not getting into the actual technicalities there as such beta, and yes, I have done my certification course on international taxation, but we are not getting into that aspect better now. So if India is a low tax country as such guys, you would want more profits guys to be shown in the Indian books so that you end up paying lower tax here. Say guys, a product is available. Say guys, you're manufacturing a product at 10 rupees in India, but you transfer that at 50 rupees to the US. 50 rupees to the US. Now for the US company as such, better the cost of procurement is 50 rupees. For the US company, the cost of procurement is 50 rupees. So they are booking a higher expenditure there, and they will want to show lesser profits in high tax countries, show higher profits better in low tax countries. So this might have an impact on the amount of transfer price. This obviously better can have an impact on transfer price. You would want to see the taxation structure, you would want to see the repatriation clauses. See guys, once you invest in some country as such, better you bring in funds, it is not like whenever you want you will take out your money better. There can be repatriation clauses. मतलब तुम्हारी मर्जी से नहीं चलेगा बेटा. There might be certain clauses imposed that only if this, only subject to this, you will be allowed to take back your money. ठीक है. So guys, you might want to take advantage of the fact of taxes better, tax differences, so that you use it to your advantage. We know better, just say we have domestic transfer pricing, section 48(2) guys in our Indian income tax. Very common better in the Indian business families. The minute the child turns 18 as such guys, what they do is they officially show that, guys, kid as an employee of the company, and they will transfer salary to his account. This is just an internal transfer guys. Now what happens better is the company might be paying a tax of 30% as such guys. When they transfer salary to this kid as such better, he might come in the basic exemption limit, or he might just pay by 5-10% of the taxes. So they're saving some amount of taxes here. This is what guys companies would also want to do guys on an international level. Transfer book profits guys in those areas. Just say guys, if Apple has a subsidiary guys in Ireland for handling all of their European operations, it is because Ireland has a very low amount of tax. तो अभी ठीक है बेटा, इंटरनेशनल टैक्सेशन में बेस प्रॉफिट एरोजन प्लान्स जो है गाइस, ऑल ऑफ दोज आर कमिंग इनटू पिक्चर. वी नो गाइस दैट इन इंडिया वी हैव आर्म्स लेंथ प्राइस कॉन्सेप्ट एज सच गाइस. दे विल चेक वेदर द ट्रांसफर प्राइस इज रीजनेबल और नॉट. इंडियन टैक्सेशन अथॉरिटीज विल हैव नो प्रॉब्लम एज लॉन्ग एज हायर अमाउंट ऑफ टैक्सेस आर बीइंग बुक्ड इन इंडिया. बट देन इफ दे पे लेसर टैक्सेस इन इंडिया गाइस, देन दे विल हैव अ प्रॉब्लम. सो गाइस ठीक है, I hope you've understood the point guys, that there will be impact of taxes. Every country as such beta would want to use it to their best advantage. Understood. Currency management guys is another important part here. When you know guys, when you know better that there are a lot of subsidiaries that you have, and there are a lot of transactions between these subsidiaries guys. Overall company level pe guys, the amount of foreign currency risk might not be that high, because if it is foreign currency loss to one area, it is foreign currency profit guys to another subsidiary, if they're not trading in the same currency as such guys. So they might want to book currency losses in those countries where the tax rates is higher guys, so that they pay lesser taxes, and they might want to show currency gains as such, but in those countries where the tax rates are lower, so that they end up paying lower tax. This efficiency guys, companies play around with all of this guys. अभी तुम लोग देखे जो बेटा the G7, they have agreed as such guys to charge a minimum tax rate. They will not go below that tax rate, and they'll obviously better this will come up a discussion at G20 summit as well. And the global economies as such guys are basically coming together to ensure that one country does not levy a lower tax and the others as such better suffer on account of it. So they are trying to implement all of that. So anyways guys, I hope you've understood the concept of international transfer pricing here. So transfer pricing guys does play an important role when a company has operations guys in multiple countries. जैसे बेटा वहाँ पे एक case study दिया था guys. Here in the books there is a case study given in the ACI material that Starbucks UK beta does really well, but in spite of that they incur losses. That is because beta they pay 6% royalty as such guys to their parent company. When you're paying 6% royalty to your parent company, you might be booking losses better in UK, but then you're actually making profits on an overall basis. So if UK beta is a high tax country as such guys, you're trying to show very less amount of profits, or you're trying to show lesser amount of lower losses better there. So वहाँ पे guys, the question of arm's length price will come. The taxation authorities will interfere and say whether this is at arm's length price or not. Is this justifiable? Are you trying to evade taxes? All of that better you will learn under international taxation, a part of paper number 7 guys. Understood sir? We have no idea. We have no idea. We have no doubt about it. Let us write all of this better in the books. Your concept book में जाके लिख सकते हो बेटा international transfer pricing. In the concept book better you can write international transfer pricing. I'm not giving an entire explanation guys for everything that is already mentioned in the question guys. I'm just going to give you brief points better there. So first thing better is companies can have operations. Companies can have operations in multiple locations. Can have operations in multiple locations. Can have operations in, जैसे बेटा if you talk about Motherson Sumi Systems guys, I discuss about this company a lot in SFM also better, that this company guys has this policy of guys CCC 15 था, अभी CCC 10 पे आया. No country, no customer, and then beta no particular component should contribute to more than 10% of their revenues or more than 10% of their profits. They have so many subsidiaries across the globe as such guys. They procure so many, they keep acquiring subsidiaries as such guys that are located in different parts. So you know beta that they have a demand for their products in multiple countries as such guys. So they acquire a local manufacturer. That is how they promote growth as such beta. For them growth beta is through acquisitions. Keep acquiring companies, local companies as such guys, and then through those local companies beta keep supplying parts. This is how they manage. So companies can have operations in multiple locations, guys, due to the following reasons. Due to the following reasons. Due to the following reasons, guys. First, most important thing, beta, is uh, lower wages, lower wages, lower wages, guys, and talent, lower wages and talent. Just say, beta, India, guys, gains. India gains better due to outsourcing of operations, due to outsourcing by other countries, outsourcing by other countries. Second beta is availability of raw materials, availability of raw materials. Many electronic manufacturers have operations in many electronic companies beta have manufacturing facilities in China, have manufacturing facilities in China. Yes or no, guys? There's a demand for products, beta. There's a demand for products. Just Coca-Cola has operations in India. Coca-Cola such guys has operations in India because there's a demand for that product. Obviously, guys, you will want to have a product. Yes or no, guys? So if you have operations as such, guys, undoubtedly, beta, there will be transfer of goods and services. There will be transfer of goods and services, beta. There can be royalty payments. There can be loans as such, guys. There will be loans as such, beta. Loans between multiple companies, between group companies. Between group companies. This is what better leads to international transfer pricing. This is what better leads to international transfer pricing. I hope you're all writing this. Companies can have operations in multiple locations, guys, and all of this better will lead to international transfer pricing. International transfer pricing as such, guys. Transfer prices are used to plan taxes. Transfer prices are used to plan taxes, are used to reduce the overall tax expense. Overall tax expense. Higher profits, higher profits are booked in countries with lower tax rates. Are booked in countries with lower tax rates. And lower profits are booked in countries with higher tax rates. With higher tax rates. समझ में आ रहा है guys? Yes sir. Also बेटा currency management में if you see currency management, higher foreign exchange losses are booked in countries. You will have to plan that, but are booked in countries with higher tax rates. Are booked in countries with higher tax rates. And high foreign exchange gains beta in countries with lower tax rates. In countries beta with lower tax rates. समझ में आ रहा है? Yes sir. I'm zooming in as such guys just in case you missed out any point. So just a brief as such beta that is required. Nothing else. Copy करो बेटा ये. After that we'll go to question number 31. ये check करो बेटा सब लोग. Check guys if you're all done with this. सबका हो गया क्या ये? चलो guys, I hope you're all done with this. I hope you're all done with this, beta. Yes, sir, we're all done with this. Now, guys, we will be moving on to question number 31. Go back to your problem solving book, guys. Question number 31. Page 9.32. A car manufacturing company. Simple questions, guys. Question number 31, 32, question number 33. All the three beta are based on international transfer pricing only. उसके बाद में बेटा we have question 34, that is like a case study involving transfer pricing. Question number 35 beta is also like case study only, but question number 35 is simple. And then beta there are additional questions for practice, for your practice as such, guys. I'll give the answers to them. You can always check. If there's any other question beta that is to be done, I will be doing it, guys. I will be doing it. एडिशनल क्वेश्चंस में ऐसा कुछ क्वेश्चन लगा बेटा जो मेरे को करना है मैं करूंगा, टेंशन मत लो. Question number 31, guys. A car manufacturing company has two manufacturing divisions in different countries. Division A in India manufactures engines for the cars. It has a capacity to manufacture 10,000 units each year. The variable cost of production is 8,000 per unit. The division can sell 8,000 engines externally to customers within India at 11,000 rupees per unit. So we have an engine manufacturing division in India, guys, whose variable cost of production is 8,000 rupees, and we will be able to sell to external customers in India at 11,000 rupees per unit. The other division, guys, division B, is in Italy, that requires 5,000 engines every year to assemble them further into cars. It purchases these engines from a vendor in Italy at a price that is equivalent to 9,000 rupees per unit. If division B were to purchase these units from division A, the transfer price beta would be 10,000 per unit, since no selling expenses need to be incurred on internal sales. Variable cost of such transfers would be 7,000 rupees per unit. If division A accepts the internal order from division B, it will have to curtail some of its external sales. Given that the tax rate is 30% in India and 40% in Italy, determine if the company will benefit overall if division B purchases from division A. If division B better purchases from division A. Just the other day, guys, in economics for finance, as a part of CA intermediate, guys, we were talking about government interventions to correct market failures, and then we were talking about how fiscal policy will influence the overall level of aggregate demand, employment, and inflation in a country. So there, but we were reading about this point only, that if you know, guys, guys, basically a contractionary fiscal policy. If you levy way too high taxes as such, but on individuals and corporates, you might see better that the businesses move out of India. So that is what happens to better international transfer pricing. If there's a very high tax burden in one country, you will want to show, guys, you will want to, guys, transfer your operations to a country better with lower tax rates. Anyways, better read the question. Read the question, guys. Question number 31. All of you guys read the question properly, better. Question number 31. Do read the question properly, guys. All of you will answer after that. ध्यान से पढ़ो बेटा सब लोग क्वेश्चन. Yes, guys, I hope you're all done with this. I hope you're all done with this, guys, and there is no doubt. Please do it properly. Yes, guys. शुरू करूँ बेटा मैं क्वेश्चन? हाँ सर, शुरू कर दो. तो guys, what you'll have to understand बेटा is यहाँ पे याद रखना guys, I cannot merely compare. See, even if there were no taxes as such, guys, it is very evident that this, guys, Indian division as such beta has a spare capacity, guys, and that spare capacity के लिए minimum transfer price beta should have been only variable cost. And even if there is no spare capacity as such beta, they're making transfers as such, guys, by incorporating opportunity cost. By incorporating opportunity cost, yes or no? So from the viewpoint of company also, guys, it would make a difference. अभी ये देखो guys. Question number 31 बेटा. सुन लो guys. Division A, guys, in India. Division A, guys, in India. Capacity is 10,000 units. External demand beta is 8,000 units. 8,000 units. Spare capacity guys is 2,000 units. 2,000 units. The variable cost per unit beta for external sales. The variable, सुन लो बेटा सब लोग, variable cost per unit beta for external sales. For external sales beta, the variable cost of production, guys, is 8,000 rupees. And also, guys, the other part beta here, the variable cost per unit, guys, for internal transfers. For internal transfers is 7,000 rupees. The selling price per unit, guys, the selling price per unit beta for the external market, it is 11,000 rupees in India. 11,000 rupees beta in India. Okay, yes sir. As far as division B is concerned, guys, division B beta, that's in Italy. Please understand beta that the requirement is of 5,000 engines. 5,000 engines. If procured locally, guys, they will have to pay 9,000 rupees. 9,000 rupees. If procured from India, if procured from division A, guys, in India, the transfer price is such, guys, the transfer price is 10,000 rupees. Division A as such, guys. These are the details. Write down these details, guys, all of you first, and then we will attempt to answer the question. सबके सब बेटा ये question लिखो, guys, properly. Write these given details better. Then we will attempt the answer, guys. We would be attempting the answer. All of you guys do this properly. Yes, guys. I hope you're all done with this, but now let us see what are the alternatives available as such, guys, to these entities. Well, let us see what are the alternatives available, beta. Alternative one तो बेटा यही है कि let division A beta in India sell 8,000 engines. So here beta we are not even utilizing capacity fully beta. Engines sell 8,000 engines locally in India beta, locally in India. And division B guys, division B beta procure 5,000 engines locally in Italy. Locally in Italy. This is one option as such guys. The other option guys that we have alternative 2 beta is, the other option beta that we have alternative 2 is division A guys will restrict external sales to 5,000 units. Division A beta will restrict external sales. सुन लो guys सब लोग, will restrict external sales to 5,000 units. 5,000 units. And transfer 5,000 units to division B in Italy. Transfer 5,000 units to division B guys in Italy. That is the other alternative guys. Other alternative is such. We will compute profitability under both of them guys. Alternative 1. As far as division A is concerned guys, division A is concerned, their revenue beta would be 8,000 engines into 11,000 rupees per unit. Their cost as such beta, variable cost beta would be 8,000 engines into 8,000 rupees. Into 8,000 rupees guys. So this beta would give us a say contribution or profit guys. Contribution of profit of 8,000 beta into 3,000 rupees, 24 lakhs. 2 crores 40 lakhs. 240 lakhs guys. Do not forget beta, in India the tax rate is 30%. They will have to pay 30% tax on this guys. 240 minus 30% guys, 168 lakhs. This would be guys the profit net of tax. Profit net of tax beta for the Indian entity. Okay, yes sir. Division B guys, their procurement cost beta would be, procurement cost would be 5,000 engines into 9,000 rupees, and that is beta 450 lakhs. Of course beta, any procurement cost as such beta, tax savings on procurement, this is an expenditure as such guys. On expenditure they would save taxes, but this is at the rate of 40%, 180 lakhs guys. So their net procurement cost is 270 lakhs. Their net procurement cost beta net of taxes is 270 lakhs. समझ में आ रहा है? हाँ sir. Division A beta will make a profit of 168 lakhs net of taxes, while division B guys would made a net procurement cost of 270 lakhs. Let me check alternative 2 guys. Division A guys, their revenue as such beta would be, their revenue beta would be 5,000 engines into 11,000 rupees. This is for external sales. And guys, it will be 5,000 engines beta multiplied by 10,000 rupees beta internal transfers. As far as their cost is concerned guys, it would be 5,000 engines into 8,000 rupees. And guys, it would be 5,000 engines guys, 5,000 engines into 9,000, 7,000 rupees. Internal transfers are only 7,000. So this beta would give them a profit of, this would give them a profit before tax beta of 10,000 engines with 3,000 rupees beta, that is 300 lakhs. Tax at the rate of 30% guys, that is 90 lakhs. So 210 lakhs. Profit after tax. Division B guys, their procurement cost will now increase. Instead of procuring beta at 9,000 rupees, they're now procuring beta at a transfer price of 10,000 rupees. At a transfer price of 10,000 rupees, that is 500 lakhs. The tax savings on procurement, of course, but as the procurement increases, tax savings will also increase. Tax savings on procurement cost as such beta would be 200 lakhs. So that is 300 lakhs net of tax. Net of tax, their procurement cost is 300 lakhs. Now think from the viewpoint of company guys. Under alternative 2, profits of division A beta are increasing by, earlier they were making a profit of 168 lakhs beta, now they're making 210 lakhs. 210 minus 168 lakhs, 42 lakhs. cost of division B beta is increasing by, cost of division B beta is increasing by, even the cost of division B guys is increasing here. Earlier their cost was 270 lakhs, now their cost is 30 lakhs, 300 lakhs, 30 lakhs. The net savings to the company beta is, the net savings to the company would be 12 lakhs net of taxes. The company as a whole beta would save an amount of 12 lakh rupees. This would be the advantage guys of alternative 2. समझ गए sir? We are only presenting the alternatives as such guys that the question asked us. Someone might say, sir, what if we just transfer out of spare capacity, and what if the other division procure, guys, the remaining units guys from the external market? How will that, impact? Just say Indian division beta will make 2000 into 3000 rupees, 60 lakhs net of taxes, 42 lakhs additional profit. And for them beta, it is only on 2000 engines that they will have to pay additional 1000 rupees. Net of taxes 12 lakhs. So that will actually increase the profit by 30 lakh rupees guys. That will actually increase the profit by 30 lakhs. We're not checking for other, we are not evaluating other alternatives guys. This is very, very important guys. What is another alternative as such guys? Say guys, alternative 3. Transfer only 2000 engines out of spare capacity. This would actually result in a higher profit beta. Guys. Company as a whole beta would save because of this. Okay, sir. Now guys, all of you better start copying this. Guys. I'll give you lesser time beta to copy all of this, and because you have to do one more question here. Yes guys, quickly copy this. Here guys, alternative 1. I hope you're all done with this guys. एक काम करो बेटा, पॉज करके कॉपी कर लो ये पूरा. पॉज करके कॉपी कर लो guys. All of you बेटा, pause and copy this. You can pause and copy this guys. Alternative 1. ठीक है? Yes sir, ठीक है. Pause and copy this guys. Alternative 2. Pause and copy this guys. Alternative 2. I've shown the revenues, I've shown cost as such, guys. You're taking changes in revenue, we're taking changes in cost. Yes, beta. I hope you're all clear about this. And then finally, this beta. Pause and copy. Pause and copy, guys. Remember, guys, I told you that we are not evaluating other alternatives because the question जो अपन को question बोल रहा है बेटा अपन वही ले रहे हैं बस. We are not taking anything else. Understood, sir? But we know better that there could have been a better alternative if you transfer only 2000 engines. Yes, sir. Got the point. Pause and copy. हो गया ना बेटा? हाँ sir, हो गया. Let us do one more question, guys, and that is question number 32. कर लेते हैं बेटा question number 32. 33 is normal. 34 is normal. Question number 32, guys. ABC Miners operates two divisions, one in Japan, the other in UK. Mining division is operated in Japan, which is rich in raw emerald, guys. The other division in UK is processing division. It processes the raw emerald into polished stone fit for human wearing. They've given us the cost details of these divisions, guys. Variable cost per carat, guys. Per carat is 2,500 yen. Fixed cost is 5,000 yen. And guys, processing में बेटा per carat variable cost is 150 pounds and 350 pounds. You know, guys, per carat as such beta basically means 0.2 grams. Carat is 0.2. For all of these precious stones, they measure it in terms of carat. Several polishing companies in Japan buy raw emerald from other local mining companies at 9,000 yen per carat. So we can sell in the external market at 9,000 yen per carat. Current foreign exchange rate is 50 yen is equal to 1 pound. Income tax rates are 20% and 30% in Japan and UK respectively. It takes about 2 carats of raw yellow emerald better to yield 1 carat of polished stone. Polished emerald sells for 3,000 pounds per carat. You're required to compute the transfer price for 1 carat of raw emerald transferred from mining division to the processing division under two methods: 200% of full cost and market price. If 1,000 carats of raw emerald are mined by the Japan mining division and then processed and sold by the UK processing division, compute the after-tax operating income for each division under both the transfer pricing methods stated above. So basically, guys, they are not asking us as such, guys, to use our brain. There is no decision making. They've given us better that this is the transfer price. Use this transfer price and arrive at profitability statement. Nothing else as such, guys. Likho beta. Likho nahi beta. Padho, guys, question. I'll be waiting for a minute. I will be waiting for a minute, guys. All of you read the question beta. I hope you all read the question, guys. I hope you all read the question better. Yes, sir. Let us answer it, guys, then. Let us answer it, but it should not take much time. It's a simple question, guys. We just have to compute transfer prices based on whatever is given, better. First, guys, is अपना क्या बेटा transfer price, sorry. There is no decision making, guys. There is no decision making in this question. ये एग्जाम में नहीं लिखना है बेटा, ये अपने लिए है. There is no decision making बेटा in this question. Understood, sir? So now guys, if I talk about transfer price, guys, if it is 200% of full cost, it should be 200% beta of 2500 yen plus 5000 yens. So that beta would be 15,000 yens. If it is market price as such, beta, transfer price beta will be equal to 9,000 yens. There are others beta who are willing to buy at 9,000 yens. Okay? Yes, sir. Ho gaya, sir. This is the answer to the first bit. Guys. Transfer price. This is the answer to the first bit, guys. Transfer price. Either at 200% of full cost, guys, or at market price. 200% of full cost, guys, or at market price. Are we clear about this? Yes, sir. 200% of full cost, guys, or at market price. Okay, sir. Now, guys, second bit beta is profitability statement. I'm sure, guys, you're all done with this. Second bit beta is profitability statement. It says, guys, compute the amount of after-tax operating income for each division, guys, under both the transfer pricing methods stated above. So there are internal transfers, but 1,000 carats. This would be the mining beta by Japan division. And guys, for the UK division as such, guys, the processed emeralds as such, guys, are 500 carats. How 500 carats? 2 carats beta for each. 2 carats beta for each stone. This would be the output of UK division. Let us not forget beta that there should be internal transfers as well, guys. ये समझ में आ रहा है ना? अभी guys, if transfers are at 200% of full cost, that is at 15,000 yens. The transfer price guys would be 1,000 carats into 15,000 yen So this beta is 150 lakh yens. In pounds beta, I would want to write 150 lakh yens divided by pound ka rate kitna hai beta? 50 yen per pound. Divided by 50 yen per pound, guys. So this is 3 lakh pounds. Apart from the cost that you are taking as such, guys, for this thing, guys, variable cost polishing ka, ye bhi low beta. 3 lakh pounds should also be considered, guys, for the other division. Likewise, guys, if transfers, अभी बनाऊंगा बेटा मैं profitability statement, do not worry. If transfers beta are at market price, that is 9,000 yen. Your transfer price as such, guys, would be equal to 1,000 carats into 9,000. That is 90 lakh yen. In pounds as such, guys, that would be 90 lakh yens divided by 50 yens per pound. 1,80,000 pounds. 1,80,000 pounds. This would be the transfer price. ये तो लिख लो, guys, and then we'll compute profitability statement. All of you guys copy this, and then we will arrive at the profitability statement. Yes guys, I hope you're all done with this. नहीं हुआ तो pause करके कर लेना बेटा, ये भी copy कर लो. Let us now compute your operating income statement guys. Operating income. Operating income statement guys. First किसके नीचे करना है बेटा? When transfer price बेटा is equal to, where transfer price is such guys. Transfer price बेटा is equal to कितना है बेटा? 15,000 yens. ये देखो guys. So there is division, mining division guys. There is mining division in Japan. This is in yens beta, whatever I'm going to write. And then beta there is this processing division guys in UK. Processing division guys in UK in pounds. The revenue per unit is such guys for them. Revenue per unit guys for them it is 15,000 yens, and for them beta it is 9,000 pounds. Sorry, 3,000 pounds per carat. Less beta your variable cost per unit guys. Variable cost per unit. This here beta it is 2,500 yens, and here it is 150 pounds. And also guys internal transfers are effectively costing them. अभी तो compute करा था ना बेटा मैं. अच्छा मैं total करा. 3 lakh pounds is for 500 carats. 600 pounds. 3 lakh pounds as such guys is for 500 carats. Is for 500 carats. Ultimately beta their output is only 500 carats. This is internal transfers. Because this is all per unit guys. Fixed cost as such beta. Fixed cost per unit guys is 5,000 yens, and here beta it is 350 pounds. Your profit per unit guys. Profit per unit it is 7,500 yens, and here guys it is 3,000 beta minus 150, 600, 500, 1100, 1900 pounds per unit. Your total profit beta, total profit would be 7,500 yens into 1000 carats, 1900 pounds beta into 500. इसीलिए बेटा मैं internal transfer ये जो था बेटा 3 lakh pounds per unit of finished product. If you want beta you can write per unit of finished product, ऊपर जो अभी copy करे बेटा, that will be 3 lakh pounds divided by 500 pounds beta, 600 pounds. 600 pounds. You can write that statement there beta if you wish to. So the total profit beta here is 7,500 into 1000. Okay, so this is 75 lakh yens, and this is 1900 pounds beta into 500, that is 9,50,000 pounds. You will have to obviously pay taxes on them guys. In Japan the tax rate is only 20% guys. 20% beta, so that is 15 lakh yens. In US, in UK as such beta it is 30%. So 9,50,000 ka beta 30% as such guys is 2,85,000 pounds. 2,85,000 pounds. So your profit after tax beta is, very simple question guys, 60 lakh yens, and here 9.5 minus 2.85, 6,65,000 pounds. If you want to convert everything beta in pounds, profits of company beta, you can convert into company as such guys. You can either convert guys into pounds or you can convert into yens. Common currency में लेके आओ. Divided by 50 yens per pound plus 6.65 lakh pounds. Divided by 50 plus 6,65,000. All put together beta 7,85,000 pounds. Or convert into yens. Your wish guys, but convert into common currency. Convert into a common currency guys. So this is the operating income statement guys. Under the first alternative where transfer price is 15,000 yens. What are you going to do beta? You're going to pause the screen and copy this. Class खत्म होने पे आ गया beta. Please pause the screen and copy this guys. All of you guys pause the screen and copy this. Yes, beta, please pause the screen and copy this as well, guys. All of you, beta, pause the screen and copy this. ठीक है? हाँ sir, done. This is the answer, guys, to the first bit. Same thing, guys, for the second bit. मतलब operating income, guys. Operating income. If transfer price as such, beta, is 9,000 yens. 9,000 yens. Okay, sir. Again, beta, there is this Japan division and then, beta, there is UK division. The selling price as such, beta, per carat. For them, guys, it is 9,000 yens now. And for them, beta, it will remain at 3,000 pounds. Less variable cost as such, beta, here it is 2,500 yens. यहाँ के लिए, beta, it is 150 pounds. Transfer price, beta, let us not forget that you will divide the overall transfer price, that is 1,80,000 pounds, beta, by 500 carats. By 500 carats, guys. 1,80,000 pounds by 500 is 360 pounds. And then there is fixed cost as such, guys. There is fixed cost. And fixed cost, guys, is 5,000 yens and 350 pounds. So your profit as such, beta, per unit. Profit per carat as such, guys, is 1,500 yen. 2,140 pounds. Total profit, guys, before tax is when you multiply by the output, guys, into 1,000. 15 lakhs. And here, guys, 2,140 pounds, beta, into 500. 10,70,000 pounds. Let us not forget to pay taxes on them, guys. 20% taxes on them, beta, would be 3 lakh yens. Company as a whole, beta, will lose here because Japan is a low tax country and you're reducing the transfer price. That means you're booking lesser profits in Japan, higher profits in UK. You will end up paying higher tax. You will end up paying higher tax as such, guys. $3.21 lakhs. So your profit after tax as such, guys, is here, beta, it is 12 lakh yens. Here, beta, it is 7,49,000 pounds. In pounds, if I convert, beta, that will be 12 lakh yens divided by 50 yen per pound plus 7,49,000 pounds. 7,73,000 pounds. This is the profit. Please understand, guys. पहले 7,85,000 था, अभी 7,73 है. This is just for our understanding, guys. Company as a whole, beta, will lose. Company as a whole will lose at a transfer price of 9,000 pounds. At a transfer price of 9,000 yens. Why, sir? As it will lead to lower profits in Japan, which is a low tax country. Lower profits in Japan, a low tax country, and higher profits, beta, in UK, This is the overall impact, guys. A high tax country. समझ में आ रहा है? हाँ सर. Pause करके copy कर लो, बेटा. We are at the end of this class as well, guys. We will wind up operating our transfer pricing, guys, in the next class. And after that, beta, we would be starting strategic analysis of operating income. After that, beta, we have budgetary control, and then we have standard costing, and finally, beta, learning curve. Learning curve, beta, is actually not a separate topic, but then we are doing it separately because you need to learn a concepts. So, guys, we are midway through, guys, through module 2 as well. Literally midway, beta, through module 2. Budgetary control is a small chapter. Strategic analysis of operating income, guys, is not that big. It might take 4 to 5 classes. Standard costing as well, guys, might take 9 to 10 classes. So yeah, another 20 classes. Hopefully, beta, we would be done with everything. Chalo, guys, please pause and copy this, and I'll see you guys in the next class, beta. Keep studying, keep revising. Pause and copy this first. Now pause and copy this. Pause and copy this. Pause and copy this. Pause and copy this. Chalo, guys, done. I'll see you guys in the next class, beta. Maybe the next class might not be a 3-hour session, guys, because we only have 3 questions left, and I might solve a question, guys, from the additional question bank. Bye bye, guys. See you guys in the next class.